2020 was a challenging year globally, affecting daily life, work, and investment. The COVID-19 pandemic led to a significant economic downturn and stock market crash worldwide. This event occurred in the Q4 of FY 2019-2020. In India, the Nifty 50 and Sensex 30 indices fell by 30 to 35%. The USA's S&P 500 index fell by 48 to 52%, and a steeper decline was seen in the Canadian TSX index of 55 to 58%, making it one of the highest market crashes of its time. Meanwhile, the China's HSI index fell by 26 to 30%. These substantial drops in the global market indices reflected only one thing: economic impact caused by the COVID-19 pandemic. What would you do when your investments are at risk? Profits are shrinking, capital is eroding, and everything seems to be going wrong. I'll tell you what we did at Savart. From the first few COVID-19 cases identified in December to the Shanghai Stock Exchange crash in January 2020, Apart extensively researched the global markets for its impact on the Indian market. Scourging through millions of indicators, Apart advised us immediately to exit 50 to 65% of investments. While this was a shock to our team, but we stuck to our core belief of not second-guessing the system's intelligence and simply following it without any factual data. There was no way to know what the crisis situation would be, but the system spoke to us through its interface that our impending doom was upon us, and the action was crystal clear: exit. We did exactly that by starting with shutting down new investments and exiting the existing investments and seeking refuge in the debt funds. We sent an email notification to all our clients and counseled our investment advisory clients to maintain caution in the markets and move to liquid assets. This crucial notification was sent to all our clients as early as the 2nd January of 2020. And this helped our investment advisory clients to avoid the full brunt of stock market crash which happened in 2020 pandemic. While the markets showed severe losses of up to 30 to 35%, our clients experienced on average 12.3% of loss. More importantly, this loss was not realized on the principal amount, but rather it was profit shrinking of our investment advisory clients that were a part of us since 2019. During the 2020 market crash, the global markets plummeted and so did their economy, showcasing that simply investing in global markets is not enough to safeguard your investments. While GDP is not a complete and accurate indicator, but it gives us a fair idea of what exactly happened. At Savart, we have developed a robust investment strategy to safeguard and balance your investments against such unprecedented events, usually termed as the black swan events. In this case, we took proactive measures by moving 50 to 65% of our investments into liquid assets as early as the December 2019 to the January 2020, prior to the market crash in 2020. Our comprehensive approach not only safeguarded their investments, but maintained balance and protected their investments against the pandemic and market downturns. Remember, everybody does well when the markets are doing well, but the ignorant investor is left in despair when the markets collapse. That is exactly where the intelligent investors thrive. The latter half of April, May, June quarter saw our investments rising again, and we made sure that we were part of the market upside as well. Good asset allocation is not just protecting investments, but also wealth creation, and sitting out of such opportunities could prove very dangerous. Our state-of-the-art asset allocation engines and EFG risk profiling systems ensured that balanced portfolios were created for each client. Our portfolios, in line with the market, have not seen too many bad days since 2020 till date, but this timely maneuver helped our investment advisory clients achieve an estimated profit of INR 400 crores. We neither profess timing the markets or making market predictions. But all we'd like to say is Apart is smarter than any other incompetent fund manager and does a much better job at making investments. Why invest based on emotions when you can do it with facts?